Good morning, everyone. I work at Morgan Stanley. I've been there for almost 15 years, all covering media, cable, and satellite. This picture cracks me up. It's like my Ron Burgundy impression or something. I need to get that updated. And I'm going to spend some time talking to you about our advertising outlook and some other points that I think you'll find interesting. Many of you probably don't know who I am, so as a point of reference, let me start off this presentation with a picture. A couple things to take away from this shot. First of all, you can see I clearly love my job by that grin on my face. So for the bosses back home, I want to make sure they pick up on that. I actually work in Times Square. I've been working in Times Square for 15 years, which may be the worst part of my job, actually. I live and see and experience out-of-home advertising on a daily basis. I think that's Nas promoting Hennessy, perhaps, up there. And the one other point that I found amazing, I don't think in 15 years I've ever noticed it, but there's actually an empty board there in Times Square. So my call to action is to get that board filled with something interesting so I can look at it on a daily basis. Here's the agenda for my conversation with you. We're going to talk about our advertising outlook and Morgan Stanley's econ outlook, which of course ties to that. We recently published our 7th annual local advertiser survey results, and I'm going to take you through some of those results this morning as well. Within that context, we're going to talk about how outdoor is viewed by those we surveyed. And then, like Jack, we're going to talk a lot about digital. And I'm going to focus both on what we see as attractive opportunities and also some of the risks we see around getting too aggressive with digital. Throughout this entire conversation, technology is going to be a recurring theme through the whole presentation. So first, let's talk about how we see the advertising market this year. 2 weeks ago, I went on a vacation with my 2 young children, 3-year-old and 4-month-old, and we drove 3 hours each way. So are we there yet? It's something I literally could not get out of my brain and had to put it on a slide for you. But I think it's relevant for the advertising recovery we've seen since the downturn. It hasn't felt great, and I think there's a lot of reasons why that's true, and it's particularly true in local, which is a big part of course, your business. I'm sure you've heard this a lot, but 2008, 2009 was an unprecedented pullback in the economy and in the ad market. Interesting statistic, since 1961, the average recession in the United States has seen advertising actually grow about 0.5%. Prior to 1991, we had really never seen even sort of a flat advertising year. 2001, 2002, also sort of the beginning of the internet advertising world, we saw sort of a 3 to 4% decline. But believe me, we had no idea we could see a down 15% plus advertising decline in 2008, 2009. And the bounce back has been less than we had hoped and less than we had expected. I think the economy is still suffering from some of the effects of that crisis. The good news is that we are certainly bullish for 2014. You can see on the far right-hand side of the slide, we're expecting 5% growth this year. It's sort of 2.5% organic growth, a little bit of help from the Winter Olympics, and then a lot of help from political advertising. In fact, if anything, given last week's Supreme Court decision, we are even more bullish on the political opportunity. So what makes us bullish? Well, at the end of the day, as Jack said, the ad market is tied to the economy. And this is Morgan Stanley's economics team outlook for 2014. 2013 was a below 2% growth year. Again, disappointing in the context of what happened 4 or 5 years ago. Q1 has come in a lot slower than people expected, and I think all of you probably know why. The weather has had a significant impact on economic activity, particularly in the Northeast, as well as the upper Midwest. And our econ team thinks that you're going to see a lot of that growth that was sort of pent-up demand in the first quarter really pop in Q2, which is obviously the quarter we're in right now. But we expect this to continue as we move through 3Q, 4Q. Those kind of 3% GDP numbers are the kind of numbers we need to see to get advertising really up and running the way we'd like to see it. Sticking on sort of the macroeconomic front, this chart looks at 2 factors that matter to advertising: GDP growth, which we just talked about, and personal consumption or personal spending. And you can see in the 2008-2009 period, we had this significant retrenchment in the economy and pullback by the consumer. And we've seen growth since then, but we're still running at rates below the sort of 2003 to 2006 period. So again, we've seen a recovery, but it's been much more tepid than we had hoped. Someone once told me, if you're going to do a presentation, always include a scatter graph and talk about R squared, because that really captivates the audience. So check that box, here it is. We do use a regression analysis. We're not just literally making up our advertising forecasts. We've done some work looking at statistical correlations going back, looking at GDP, Olympic election years. Car sales actually a pretty good predictor of ad growth. And the good news is that this calculation spits out actually a 5.5% growth rate for 2014 advertising, even a little bit above what our kind of bottoms-up forecast says. Everyone here should feel pretty fortunate to be in the outdoor industry. The rest of local advertising has certainly been really challenged. You know, when we look back at 2008 and compare dollars today to dollars then, national advertising has effectively fully recovered. You can see the blue bar, about 101% of the 2008 spending level. Outdoors right around there, 99%. Local still running at about 80% of what we saw all the way back in 2008. And of course, as you probably know, the big driver of that is what's happening to the print business. It's been interesting, as online advertising and the internet have grown, we've just seen significant deflationary pressure on pricing across all advertising, and so that's particularly hit the print business. This is our forecast for 2014. You know, from left to right, starting with the yellow pages and newspapers down pretty significantly, magazines flattish, radio flat. The areas of growth are really outdoor, national television. Local TV, we expect obviously a big year because of the political year, and then online advertising. We've really started to think about advertising into kind of two buckets, print and everything else. So for 2014, yes, we have 5% growth, but it's actually print down 5 and everything else up 8. So there is some underlying strength, as you can see, in the economy. If you look at who's gaining share and who's losing share, this chart shows you the blue is 2014, the yellow is 2013, so you can see the difference year to year. Again, internet gaining share, online advertising gaining share, about 2 percentage points of US ad spend. We expect to move into internet this year. That's actually down a little bit from last year. It was about 3 percentage points or 300 basis points. And again, most of the share gains are coming out of newspaper, yellow pages, and magazines, with outdoor expected to effectively hold share. Stepping back from 2014 to look at sort of a longer period of time from 2010 to our 2016 expectation. Again, total US advertising, we expect to grow around 3.5% to 4%, with print down 5, online up 15, and everything else right in that 3 to 4% sort of wheelhouse. As Jack touched on, there's a lot of stuff going on with online advertising. You can't really just describe it as the internet anymore. There's a lot of pieces to it. We mentioned total advertising for online is supposed to grow about 15% over this 6-year period, but there's a lot of different pieces here. So mobile is really exploding. Mobile advertising up 75%, admittedly off a very small base. Online video, which is dominated by YouTube, of course, growing 25%. Search, which is the largest piece of online advertising today, again, led by Google, growing 10%, which is still a huge growth rate on a lot of money. Online advertising is about a quarter of all ad spend at this point. And then all the other stuff, display, think of Yahoo, think of your basic website, banner ads, growing kind of 4 to 5%. What's happening in mobile is pretty incredible from a usage perspective. These are monthly minutes, according to ComScore. So just in the last year, we've got a 40% increase in mobile minutes, or I should say total online minutes, again, led by mobile. We're up to about 180 billion minutes a month. And I know from my internet colleagues, they like to quote everything in minutes because the numbers sound even bigger. The good news, again, if you look at what's happened with online advertising over the last 30 years, since 1999, 15 years, excuse me, outdoors held market share nicely. We don't expect that to change, even though online continues to grow. So let's spend a few minutes looking at our survey results, which we published literally last week. Asked about 200 small business marketing executives and decision makers across verticals in the U.S. How they're feeling about the ad market and where they're planning to spend their money. Good news is it was quite a bullish reading looking out over the course of 2014. We asked people, how many of you expect to have your ad budgets flat to up over the next 6 months? And we had a 92% result, up at the higher end of the historical average of our survey, which has now gone back 7 years. Roughly a quarter of those we surveyed said they plan to increase their ad budgets in the next 6 months. When we break it down by vertical, this may or may not surprise you, but the auto marketing folks were the most bullish, with 30% expressing an intention to increase their ad spending this year. Food and beverage, number 2, leisure, retail, services, and financials, and real estate down at the right side of the page with only about 20%. One of the ways to gauge how the economy and how the mood of advertisers is to ask about how the economic outlook and economic situation is impacting budgets. And what's interesting about this chart, you can see the blue at the bottom is where we focus. So going down the top, from top to bottom, the red would be an answer that the economy does not impact how our ad budget is calculated or put together. Green is a small impact, yellow a moderate impact, and blue a great impact. And you can see during the tougher years of 2009, 2010, that got up to almost half of all respondents saying the economy had a great impact on their advertising spending plans. 2014, which was done a couple months ago, we're down to about 28%, our lowest reading since January of 2008. So I think advertisers, particularly local advertisers, are feeling a little more optimistic, a little less sensitive to the economy than they have over the last 6 years, which is good news. So what do advertisers want from where they spend their money? What are they looking for, and how does outdoor stack up? So one question we ask is, which factor in determining where you spend your money is most important to you, or extremely important, excuse me. And the thin blue bar is 2014 survey, and the blue thicker bar is last year's survey. ROI consistently led as number 1. No real change. 85% of those we surveyed said return on investment is extremely important in how I allocate my advertising dollars. Targetability, number 2, more or less the same, about 2/3, same as last year. Interestingly, reach and price came down a bit, still incredibly important in both cases, with roughly half of those we asked saying it's extremely important, but a little bit less than last year. Another question that we find really fascinating is we ask advertisers, if you look back 2 years ago at where you spent your money, and then 2 years from now, where do you plan to spend your money, what kind of market shift, allocation shift of your ad dollars do you expect or have you seen? And again, we get roughly the same answer every single year, which is the internet is going to gain about 1,000 basis points or about 10 percentage points of spending, with the vast majority of that coming out of the print platforms. Outdoor, interestingly, picking up a little bit of share in the minds of those we've surveyed. It's interesting, internet advertising in the survey is reported to be about 27% of ad spend for those we've surveyed. It was, call it 15% back in 2008, but most of the shift happened between 2008 and 2011. We've actually seen some stabilization in the last few years. So I think we may be reaching some sort of normalization despite these indicated intentions to shift money. One of the other questions we ask people is about their pricing expectations. Again, coming back to sort of the mood of the advertiser. How many expect to have the ad rates they pay flat to up over the next 6 months? And again, you can see it ranked by media. And it's interesting, out of home or outdoor had the biggest increase in 2014 versus 2013. Over 90% of those we surveyed who spend money on the outdoor advertising expect the prices they pay to be flat to up. That's our highest reading ever and up a lot from last year. About 26% expect pricing to go up in the out-of-home business. We also ask about contract lengths. This is an interesting result, too. We sort of had the barbell here. What is the typical length of contract for outdoor ad buys for you? Greater than 6 months went up to almost 50% of those we surveyed, while less than 3 months also increased. So the middle got carved out. It may be the impact of digital driving some on the shorter cycle, and maybe more of a normalization and static to the kind of lengths we saw, pre-crisis. Okay, for my last section, I'm going to talk a little bit about digital. Like all of you, we are quite bullish on the opportunity for digital billboards and integrating more technology into your business. Creates opportunities to attract national ad dollars through shorter lead times, real-time changes to campaigns, and then there's sort of the next generation opportunities like location-based services and near-field communications, the Internet of Things, all of which create tremendous opportunity for those with that incredibly high-value real estate out of home. Of course, there are also risks, and I think what we've watched over the last 4 to 5 years is this balancing act between supply and demand that digital really forces the industry to grapple with. And of course, we have some regulatory questions like we've seen in Los Angeles around digital. Well, I'm going to focus on the supply point, because I think it's an interesting one. Since 2010, the number of digital boards in the US have roughly doubled to about 5,000. And as you all know, you're going to get multiple turns per board, so we're looking at something like 30,000 digital faces. Again, up double from just a few years ago. That's a lot of increase in supply. One of the things that if I can dare to speak on behalf of the market, one of the things the market likes about investing in outdoor companies is there is a relatively fixed supply of inventory. The Highway Beautification Act helps us on the federal level, and then of course there are local municipal ordinances and other issues that sort of keep a lid on supply. Why is that good? Because when you have too much supply, it can really hurt pricing. And this is a chart that looks at CPMs across different platforms. Premium online video, think sort of Hulu, $26 CPM. Broadcast TV, $16, all the way down to your news feed banner ad on your Facebook page, which is getting about 20 cents. So what does this all mean? There's not a lot of supply of Hulu premium advertising, and yet the advertising community desperately wants that inventory. So as you can see, prices go up. Think about television. Television viewing, roughly flat over the last several years. But if you include things like the DVR and video on demand, probably a reduction of supply of ad impressions. This is why every year in the upfront you see TV prices go up 5 to 10%. Broadcast TV continues to drive pricing despite having lost about half its audience over the last 20 years, 20, 30 years. So you really got to be careful as you increase supply. You think about your user-generated online video. YouTube has tremendous viewership, but the ad rate on the proverbial dancing cat video is now down to about $3 if you want to buy one of those ads. Again, Yahoo Display, same thing. They have tonnage, but there's just not enough money chasing a growing supply, which puts pressure on pricing and makes the business a little tougher to grow. So you really need to be careful as you roll out new digital inventory to make sure that there's a keen look at outdoor, at local demand in that market to keep that balance in place. The things I'd like you to take away from my presentation are, first, we're quite bullish on 2014. The Morgan Stanley Econ team expecting an acceleration in GDP growth starting in the second quarter. And as a result, US advertising, we're expecting a 5% growth year this year. The major share shift within advertising continues to be out of the print platforms into online. And online is made up of a lot of different buckets, but mobile and video being the ones that's got the fastest growth, with search being the largest, growing about 10%. Our perspective is outdoor is really well positioned to continue to grow along with the overall ad market, probably a little bit ahead of GDP, with huge opportunities in digital to attract more national dollars. But at the same time, we want to make sure that the supply-demand balance is measured well and captured as people think about deploying new capacity.